Hello, and welcome to our Breakwave Day 2023 event. I'm John Cardenas, founding and managing partner of Breakwave Advisors. This is our third annual Breakwave Day event, an event that has proven quite successful in the last 2 years, and we're happy to be here once again. Over the next 2 hours, you're going to hear views and opinions relating to commodity shipping, mainly dry bulk and tankers, from some of the brightest minds in the industry. Make no mistake, the last year has seen some of the most dramatic developments in both of these industries, with significant disruptions due to 2 ongoing wars, wild price swings in both shipping segments, ongoing government interventions across the globe in the capital markets and currencies that greatly affected global trade flows, and of course, volatile freight markets, with last month's surging dry bulk rates being the latest example. Yet, where there is uncertainty, volatility increases, and the potential for higher returns comes into play. For shipping, such potential returns can be exceptional, and the shipping industry is well known for that. At Breakwave, we always strive to provide as much information as possible to all investors from institutional-like sources, and make such information that only professional investors used to have accessible and free to all. Today's event is part of such an effort, which combined with our regular research publications and frequent updates in our Insights webpage, should hopefully continue to add value to the investment process of such exciting industries for all of us to invest and trade. Now, before we begin, I want to mention that this is a live event, so I would like to apologize in advance for any mishaps during this broadcast, which includes presenters and participants from all around the globe. So now, with no further delay, I would like to introduce our first segment that focuses on the current state of the dry bulk market, as well as the outlook for the years ahead. We're very excited to have with us our first presenter, who in my opinion, is one of the most rounded analysts in the dry bulk industry. As the head of dry bulk research for Clarksons, Luisa Follis has been offering some very detailed thoughts on dry bulk shipping, not only by focusing on the microcosm of the sector, but also by incorporating a complex world of geopolitics and broader macro developments that have been increasingly affecting the shipping markets to a much greater degree than ever before. Luisa has spent most of her career in shipping with more than 20 years of experience on the research side. And as a result, she has seen up and close multiple shipping cycles. Now, history does not repeat, but it rhymes, as they say, and this is absolutely true for the shipping market. Now, with that, I would like to introduce Luisa from Clarksons, that is joining us today from Geneva. Good afternoon, Luisa from New York. The floor is yours, so please go ahead with your presentation.
Thank you, John. We appreciate being asked to participate in this event. Thanks very much. What I'll do is run through some of the key slides, the key fundamentals that we believe are affecting our business at the moment, affecting the dry bulk market. And I hope that we'll be able to share some of the insight into some of these more important factors that are driving the markets today, and also in terms of what to look out for in the months and the year ahead. I think just to begin with here, it's important to put things in context and then to look at where we've come from in terms of the longer term history on that BDI. Here we've taken the Baltic Dry Index going back to 2013, so we're sort of going back just over 10 years. And we can see that for quite some time, we've really had this period of low volatility, or certainly lower volatility than the period that preceded it. However, once we sort of got to that 2019 mark, and certainly into 2020 and the uncertainties that COVID threw upon all of us, the dry bulk markets did see some reaction, as did many of the financial markets and commodity trades worldwide. And we've seen since then tremendous amounts of volatility, which includes a huge increase in the BDI from trough to peak. And yet again, at the end of 2023, another big spike that we're experiencing today. The overall market itself during this period, and I've sort of highlighted it there in yellow, the yellow ring, and just to sort of bring that into a bit more detail, plenty of fundamental factors, as well as geopolitical factors that have driven the market. I mean, a lot of these events are very much unforeseen, others that we have managed to anticipate in terms of trade trends and fleet growth. But overall, what we've seen here is huge freight rate volatility between the years of 2020 to 2022, and then again in the latter part of 2023. So just to concentrate perhaps on the last few months, or the months of 2023, what we've seen here is the amount of dry bulk trade really surge ahead, really increase, and you can just about see it on the right-hand side of this chart here, and certainly towards the end of the year, that grey section rising up to levels that we've not seen before. If we break that down a little bit, so we're just taking here that same information and breaking it down into the dry bulk trades on an annual basis, we can see that those major seaborne flows have shown an increase in 2023, whereas in 2022 we did get a bit of a slowdown on the volumes on account of slightly lower iron ore trades, and of course the grain trades were quite significantly hit last year. We also look at the ton mile, so that really is, for those who are perhaps not so familiar, we look at not just the volumes, but we also look at the distances over which those volumes trade, which is increasingly important to include in your analysis. And that, of course, means that longer distances for these for the larger cargoes have a huge influence on the freight rates and tend to support freight rates when the numbers go up. And that's exactly what we've seen in 2023, is quite a significant rise in the overall seaborne ton mile for the dry bulk market, as well as the demand side for the market. So this is the availability of cargoes, as it were. We also need to look at the supply side, and overall for the dry bulk fleet, so this is the amount of ships that are available to charter in the market. We've seen the dry bulk fleet grow at about 3.5% this year, so it's not insignificant. However, if you follow that yellow line on the left-hand side, that chart going backwards, we can see how previously, historically, the fleet growth has been much higher over the last 10 years or so. Going forward, we do have an outlook in there, and going forward, we are expecting fleet growth to maintain at these kind of levels for a couple of years before dropping down into 2026, 27. At that point, we expect an increased amount of fleet renewal and an increased amount of older tonnage to leave the fleet, and therefore a little bit less fleet growth. Another factor to consider, particularly this year, has been congestion. What congestion does is tie up tonnage. It effectively means that those ships are not available to be chartered out. Over the last 18 months to 2 years, we've seen the opposite effect. We've actually seen that congestion ease overall. And these figures here from the Clarkson's research department are a broad-based survey, or a broad-based indicator of what's happening to those vessels. How much time are those vessels caught up in congestion or queues or delays? And in fact, what we've seen is a sharp decrease in congestion. The importance of this, of course, is that the fleet itself effectively grows once you get less congestion. And each vessel, instead of doing, say, 5 or 6 voyages a year, could perhaps do 7 or 8 or 8 or 9 voyages a year. So the impact of lower congestion is actually a gain on efficiency. And that's exactly what we've seen through 2022 and particularly 2023. And even though we've got that surge in tons carried, we haven't had exuberant freight rates for most of the year, simply because there's been huge efficiency gains, particularly at the larger end of the dry bulk fleet. So overall this year, what we've seen in terms of freight rates, here, if we look at the red line, which is 2023, we can see that those freight rate levels trade at well below the 5-year average for most of this year. The first chart on the left is the Capesize market, so the larger end of the fleet, and on the right-hand side is the Panamax market, so there we're looking at the mid-sizes. In both cases, we can see that the red line has has predominantly been below that 5-year average. More recently, however, what we've seen into Q4 is a different set of circumstances where those rates have been pushed up, have seen a lot more support. And I'll go into some of the reasons why for the Capesize market, we're now exceeding the levels that we saw this time in 2021. And certainly for the Panamax sector, the mid-sizes, we're getting close to those 2021 numbers and certainly exceeding the 5-year average range. So it's quite a unique situation whereby we're facing strengths on both the larger end and the mid-sizes, to some extent caused by fundamentals in the shipping arena, but also by unforeseen events. For the Capesize market on the left-hand side, we've just had this surge in volumes in the Atlantic. What kind of commodities are we talking about here? Well, it's all about the iron ore and increasingly the bauxite that plays a role in the Capesize trades. We've had more Brazilian iron ore in particular in the second half of this year, which is not uncommon. It's just the strength of those flows has been unabated by fairly decent weather conditions. So no controls, no real constraints on the export of those iron ore flows. And the iron ore prices have been pretty strong as well. So that's every incentive for those miners to get the iron ore into the market. Secondly, the bauxite increasingly is coming from Guinea into the Chinese market. So traditionally, China would take bauxite from sources, from origins closer to home. As those origins have been closed off, China has been forced to take bauxite from further afield in Guinea, where it's made huge investments. And those investments are now paying off in terms of volumes, cargo volumes, predominantly on the Capesize market. On top of that, the third cargo that's carried on the Capes to about 30% of the Capesize market, 20% of the Capesize market is coal. And we've seen that those coal trades really increase into China, but also particularly into India so far this year. The result of this strength in the Atlantic has been a bit of an imbalance in terms of basin positioning. That means how many ships are available in the Atlantic, how many are in the Pacific, and we're now, partly due to these efficiency gains, almost sort of out of turn with where we were this time last year. On top of this, we've also had some broader, more positive economic news coming from Beijing, with perhaps more targeted or surgical stimulus packages aimed at the property and construction sectors. So that sort of lifted sentiment, I think, in the overall market. That was quite tangible about 3 or 4 weeks ago for the Capesize sector. In addition, because of the strength in the Capesize market, what often happens is that shippers will split the cargo. So the cargo can go onto 2 Panamaxes instead of 1 Capesize. However, this time round, that's increasingly difficult because the mid-size market, the Panamax market, is also seeing quite a lot of support at the moment. A lot of this is because of the grain trade from the Atlantic. At this time of the year, we do have the US flows coming out of the US Gulf, and we also have a heightened amount of Brazilian exports. So Brazilian exports of beans and corn so far this year are up by about 20%, and that's led to a lot of congestion at Brazilian grain ports. We've also got high coal volumes in the Pacific that are maintaining the strength, maintaining the support for this mid-sized Panamax trade as well. So the vessel availability of Panamaxes has actually come down over the last few weeks, and this tightness in the market, of course, has lifted freight rates. A lot of this is because of the difficulties faced in transiting the Panama Canal. And of course, this news has hit the mainstream press, whereby the Panama Canal Authority has had to restrict flows, had to restrict transits on account of low fresh water levels in the reservoirs that feed the canal. Because of that, the ships have had then, therefore, to look for alternative routes, which inevitably involves longer mileage, we call it longer ton mileage, and that in effect stretches the fleet even further and creates the imbalance between the Atlantic and the Pacific, and a positioning problem for many cargo owners as well. So these two factors I mentioned, first of all, the iron ore trades from Brazil really coming up strongly into late Q3, early Q4. And we can see there that for the year to date, for the first 10 months of this year, Brazilian iron ore trades are up by about 7% year on year. The red line is 2023, and you can see how that's been outpacing 2022 for most of this year. Even more so, we've seen this trend of a strong 2023 on the bauxite trades from Guinea, whereby the red line has exceeded the dark blue line. And again, it's highly seasonal. So this surge in cargoes from the end of Q3, early Q4, and we're still feeling that today in the Atlantic market. Of course, the majority of these commodities that we talk about on the dry bulk market go into China, and China's imports, contrary to perhaps what we've read in the newspapers, what we've seen online about the Chinese economy perhaps suffering this year. In fact, on the commodity front, what we've seen are very strong levels of imports if we combine here the key imports for the Chinese market. So here we've taken things like iron ore, coal, bauxite and grains, so some of the key drivers of the market, and we can see that overall the imports are up by about 14 or 15% year on year by the end of October. Coal has been an important part of this process, and the coal imports for China have probably been the most dramatic, with the increase showing about 55 to 60% growth year on year. Really, as the economy comes back from the low coal burn levels of 2022, much of the country was in lockdown mode, but also on account of low hydropower levels, and as the utilities increasingly turn to the foreign markets rather than domestic markets, and we think that's to do with the qualities that are available at the certain price levels that the foreign overseas markets offer the Chinese utility. I also mentioned disruption in the overall dry bulk trades, and I think probably the one that has taken the most headlines is the Panama Canal. And we can see here that when we look at the water levels for the Gatuan lake that feeds the canal, here we've got the 3-year high-low range, the grey section. We've got the average there in black, and we've got 2023 on the red line. And we can see how far below average levels the water levels are in that lake, just as an indication. It's not all the water that goes into the canal, but as an indicator, the low kind of water levels that we're seeing in Panama at the moment. As a result of this, of course, the Panama Canal Authority has restricted the amount of transits in place, and the dry bulk vessels are tending, as I said, to go to take different routes rather than wait, and rather than even pay up for more expensive transit. A lot of owners and operators are now choosing to go a different route, and that invariably involves a longer haul way of getting from the Atlantic to the Pacific. I mean, these are just examples from the US Gulf. If we were to take grain from the US Gulf, for example, into Japan, a kind of an idea of the additional ton mile that implies by perhaps instead of going by the Panama, going by the Suez, you're looking at 50 days. If you go via the Cape of Good Hope, it's that's 54 days, not 545, 54 days, and then Cape Horn is 58 days. So in general, you're seeing that increase there on the ton miles because of these alternative routing processes. So we can ask ourselves, with all this disruption, what's next? What else do we expect, or what do we expect to happen in response to these very, very high freight rate levels? I think, overall, we can look at some of the market reaction to the rates, and that market reaction will probably involve higher speeds. On average, so far this year, the vessel speeds have been lower, 1 or 2% lower than in 2022. So we do expect the vessel speeds to increase, particularly on the Capesize market in response to that demand surge in the Atlantic. And then also, we're already seeing vessels moving, positioning themselves empty, ballast into the Atlantic in order to take up more of those cargoes that are available. Secondly, we do have a seasonal impact on the dry bulk trades in general, and it's not just the grain trades that have that. We also get some impact on the mineral side. Normally, into the early part of the year, normally we see freight rates come down, really as a lot of the Chinese market does take a break and does take time off, and it does tend to coincide with that early part of the year. What we've got on the chart on the left-hand side is the Lunar New Year holidays, and then having that as our sort of midpoint, the 14 days before and 14 days after Chinese New Year, and you can sort of see that general trend of the freight rates coming down. The weather conditions do tend to deteriorate in the Southern Hemisphere at around this time of year, December, Jan, February. There's a chance that this year could be different because of the El Nino climatic conditions, but generally speaking, we do tend to get a bit more disruption to the trades, to the iron ore trades, and even the coal trades at this time of year. This time round, we are facing some quite unusual and sustained upside risks, however, that could add support to the mid-sized sectors, to the Panamaxes, to the Supramaxes, and that might lead to a floor underneath the market. I mentioned the Panama Canal disruption, and for those owners and operators using the Suez, we've seen just this weekend of the heightened security risks in the region, and perhaps more owners and operators choosing to go even longer haul routes instead. And on top of that, we've got the high levels of Brazil grain port congestion, which is absorbing about 150 ships at the moment. So on the other side of the equation, we do need to look at the dry bulk fleet and the deliveries there that we're expecting into 2023. So the rest of 2023 and 2024. So for the rest of this year, we've perhaps got a couple more vessels to come into the market, and for next year, we're looking at about 30 to 35 new Capesizes. 30 to 35 million deadweight ton to be added to the fleet. On top of that, of course, we do have the removals from the fleet. So we've got about 13 million deadweight that we forecast to be removed from the fleet, which leaves fleet growth at about 3%. Into 2024. We believe that most of this fleet growth, however, will be on the mid to smaller sizes, so perhaps keeping some tightness on the Capesize market for next year. In summary, I think it's important to look at the overall macro situation and see that GDP growth next year is expected to be about 3 to 3.5%, led by emerging market Asia, including China to some extent. Chinese GDP is expected to moderate, and with the extra stimulus packages could really boost some recovery in the housing and property sector. We don't expect that to bounce back, but maybe we've seen that bottom out through 2023. Overall, for next year, we're looking at a rise in global dry bulk trade of about 2% overall, but this will differ according to commodity basis. More iron ore, a little bit more coal, a lot more bauxite, and a decent amount of additional grains into the market. And as I said, fleet growth to average at about 3% overall, with most of this in the mid to small sizes. Plenty of room for tightness in the market and volatility, given congestion trends and efficiency, as well as potential for trade disruption. And finally, huge amounts of risk always at play, both on the vessel side, including vessel speed and regulation, but also weather-related and even policy and geopolitical risk always tend to come into play for our sector. So I think that's most of the key points from me, but I'd be happy to take any questions. Thank you. Thanks, John.
Oh, thank you, Luisa. That's extremely interesting. I think what struck me was that we start talking about canals again, and I don't remember the last time that shipping was faced with this type of issues. I mean, probably you have to go back to the 70s, I would imagine, talking about the Suez Canal, and suddenly, both of these canals are coming into play. Now, obviously, the Suez Canal situation is kind of difficult to predict or make any type of assumption, given that it's has to do with the war. But how do you feel about the Panama Canal? I mean, it took like 9 or 10 months to get where we are today. So, a reasonable assumption would be to, extrapolate that and say, in order for this to normalize, if it will normalize anytime soon, it will take at least, similar amount of time, maybe a year. Do you think that's a fair assessment? Again, it depends on weather, very unpredictable, but how do you feel about that?
Yeah, I mean, I think, as you say, having a canal out of action or a canal, not being used to its full potential can have very immediate and dramatic impacts on the market. I take your point about, we'd have to look back to the 70s, but actually you just need to look back a couple of years to what happened in the Suez in 2021. The Evergreen ship, and how that had an immediate impact. And that was fairly short-lived, of just a week or two. So certainly this situation with the Panama Canal is pretty severe. It does appear to be lasting into Q1. I think the Panama Canal Authority itself has already put those restrictions in well into February, if not March, if I'm not mistaken. And we really do need those rains to come back. We need that water level to rise before we start to see a more normalized situation. So I think as far as the freight rates for these sort of mid sizes, by that I mean the Panamax and the Supramax market goes, I mean, certainly the restrictions on the canal do pose an upside risk to the market, albeit in an environment of a growing fleet supply, but it does pose some support, some upside support to the overall market. But it's difficult to say how long that will go on for. It's probably a weather-related issue more than anything else.
Of course. One last question, and I think that's very topical because this week you have the COP28 conference in Dubai. That's the United Nations Climate Change Conference. And, China will import like 55 or 60% more coal this year. And as we know, coal is such an important commodity for dry bulk shipping. How do you see, this market developing in terms of volumes over the next few years? Do you think that the argument of a continuing growth in terms of Chinese importing coal is valid? Do you think that we revert back to the mean as we move forward? Because that was a significant amount of coal that China imported this year. What are your thoughts there?
Yeah, I think it's going to be quite tricky to assess whether China will use domestic coal, because of course China is the largest producer of coal in the world, as well as being the largest consumer. So technically speaking, it doesn't have to import the amount of coal it does, but a lot of it, of course, is due to the financial advantage, perhaps, of importing coal rather than using domestic, and maybe also, as I pointed out, perhaps even the quality of the coal of various sources compared to domestic. Do I think this trade will collapse tomorrow? No, I don't think it will. Of course, as we move further into the decade, to mid-decade and towards the end of the decade, then potentially there will be less use of coal in China. Whether that will manifest itself in less imports or whether it will mean less domestic production remains to be seen, and could well be a policy decision rather than an economic decision. But certainly China is moving in the direction of increasing its renewables. Absolutely, but it will take some time yet for the market to shift away from this kind of high levels of imports that we've seen this year, potentially leveling off into 2024 and 2025.
Yeah, that's great. All right, so yeah, as we have said before, I think this is very useful to see how people who receive real-time information from the shipping and commodity markets think about the outlook, versus most of the shipping analysts that just process such information on a second-hand basis. And Clarkson is the premier house when it comes to shipping research, and we're very grateful for having Luisa with us today. Thank you again for your time and insights. And we'll be right back with our first panel of the day on dry bulk shipping in 20 short seconds. Welcome back. Our first panel of the day also contains some of today's top analysts in the dry bulk space that, similar to Luisa, also receive and process first-hand information and thus can speak about their views and outlook for dry bulk shipping as they see it from their respective positions. So today for our dry bulk panel, we're excited to be joined by Liz Gao, Senior Research Analyst for Iron Ore at CRU, who is joining us from Singapore. Eva Chima, Head of Research and Valuations at Seabourn Shipbrokers, who is joining us today from Athens. Mark Bochet, Director of Dry Bulk Shipping and Offshore Research at Maersk Tankers, who is joining us from Copenhagen. And Pranay Shukla, Head of Dry Bulk and Commodities Research at S&P Global, who is joining us today from Singapore. So let's jump straight into our discussion. And my first question is for Eva. And, in the last month, obviously, whoever follows dry bulk shipping knows that rates have surged well below expectations, surprising most people in the industry. And in fact, the intensity of the increase were exceptionally strong. We're talking about multiple standard deviations from averages that we're used to. And it's something that the industry rarely, if ever, has experienced in the past. Now, as you look back into the events of the past month or so, what do you see as the main causes for such a rally? And do you think this is an isolated dynamic for the market, or is something that we should prepare to face going forward? And I'm talking about averages here. It's more about these spikes in rates, these intense spikes in rates in the dry bulk market. So what do you think, Eva?
Thank you for the kind invitation, and thank you to Luisa for the very nice presentation. I think I was personally taken by surprise by what the market achieved in the past month, and I'm solely referring to the Capesize market, because we have seen from the rest of the sizes that there has been a more, let's say, steady, less volatile performance throughout the past months. I think what happened in the beginning of the year was that the expectations for China's opening were set very high. And I think people did not realize that there was this COVID fatigue in the world's second largest economy, meaning that as soon as China would open, its consumers would not jump back to investing in property, which is what most people would like to have witnessed. And in hindsight, they didn't do that. So I think we've gone from a, let's say, prolonged period of disappointment first, let's say 9 months of the year, very disappointing months, especially in regards to the bigger sizes, where rates have completely underperformed the past couple of 2 years, to suddenly rates spiking. One thing is that obviously China, by delaying taking some stimulus measures and not just announcing stimulus measure, but taking specific measures to support its property sector, because its rhetoric in the beginning of the year was, okay, let's focus on other industries rather than the property sector. But then we saw that it slightly changed as months were passing by. Why? Because obviously the property sector is very important for the entire GDP of China. It has a huge weight on China's GDP. So I think these measures intensified. And it took some time, obviously, for these measures to filter through the economy. These things, albeit announcements, make everyone very happy. The positive effects are rarely seen very fast. And I think this is what we're witnessing here. So it's a prolonged period of, first 3 quarters, very disappointing. China has been increasing its steel exports, decreasing its steel imports. So most of the iron ore imported during this time was consumed, but not for internal usage. Now we're suddenly seeing that we've reached a point where positive signs are finally manifesting. And one of them being that new home prices in China were originally set to decline this year. Now we're expecting a small increase. It could be anything from 1% to 2%. Last quarter data will provide a more clear picture. And at the same time, this coincided with very low inventories of iron ore, 6 or 7 year lows. So I think it was, let's say, the perfect storm for the Cape-size market shooting up. The rest of the sizes had already been showing a more, normal improvement throughout this period of time. I just want to point one thing here. I mean, people sometimes get overly excited or overly disappointed. And I like to say that things are never as bad and never as good as they appear to be. We've seen Capes, if someone saw today's closing, Capes dived again into 35,000 per day region, while they had surpassed 50,000 per day in the previous week. I say we expect to see more volatility coming in. Is this better than a slow-moving, disappointing market? Absolutely. But just this thing that this is not going to be a straight line recovery, not in the Cape-size market for sure. There are going to be reasons that the market will make the market slow down. Luisa mentioned, obviously, the first months of the year are never, the best for the market. But generally, I do not personally believe that appetite for property in China has still reached a point where someone could feel completely comfortable with where iron ore imports will go next. So I think this is replenishing because it needs to happen, because there have been signs of improvement. At the same time, China, there's no lack of property in supplying property in China. There's a lot of it. So there will be some more time of, maybe disappointing rates, maybe rates going, in a better, performing better again. I just don't see it as something that will last in the same, let's say, very impressive way it started last week. But, we should always keep the positive at the same time, that things are going towards the right direction.
Yeah, I mean, it's interesting that the past month reminded us how volatile the industry can be, and probably we should be prepared for something similar in the years to come. So I want to move a little bit more to the fundamental issues now, obviously, as we look at the past year and see how that might set up the stage for 2024. So I want to turn to Liz and talk a little bit about iron ore, which is one of the main commodities transported by dry bulk vessels. So iron ore fundamentals seem quite odd in the past year when you look at China. Like, imports are up something like 6%. And yet still production in China is up only 1. And that's in addition to a big drawdown in inventory. And now that's it somewhere close to 6 or 7 year lows. So when you see that in isolation, you have a lot of imports to iron ore to produce steel, but then steel production is not really catching up to these numbers. What do you think about that? I mean, how do you see the relationship between iron ore imports and steel production? And what do you think about next year?
Thank you, John, for having me. I mean, it's exactly what we have noticed this year is that the iron ore imports increased quite a lot this year, but crude steel production remains relatively flat. One thing I'd like to clarify here is that the crude steel production doesn't necessarily mean everything about the iron ore imports demands, even when inventory levels remain low. Why? I'll explain to you the few reasons. First one is that China is importing a lot of low-grade ores this year. So the reason for steel mills to use low grade is that steel margins this year have been really, really low. So the steel mills are bleeding at this very moment. We spent some time back in China and talked with a lot of steel mills. They mentioned that they are keeping the production high in order to maintain their market share. So hoping someone else will leave the market first. So they use low-grade ore to control the cost and productivity, which means you use the same amount of ore, but low grade will produce less crude steel, right? And then second thing is that the scrap rates in crude steel production have been low this year, which means that more hot metal is charged. So this year, as Eva just mentioned, very weak performance in real estate market. That thing resulted in less demolition. So less demolition means less scrap availability. So the crude steel production charge more hot metal, which means iron ore consumption is increased. Third thing is that flats performance this year is better than the longs products, right? Most of the flats were built through the BF and BOF routes, which means that even from the total crude steel production perspective, the amount remains flat, but iron ore consumptions, iron ore demand was really higher. Last but not least is that we heard Chinese domestic production down a bit, which resulted in a higher imports demand in 2023. So, just above the four reasons, I mean, China's importing low-grade ore, the scrap rates, the flats performance, and also China's low domestic production has resulted in the situation now that when you're seeing iron ore imports is really high, but crude steel production actually remains flat. Yeah.
Oh, that's very interesting. I think that's exactly what we're looking for. Just a little bit deeper into what's happening, and I think that makes a lot of sense when you analyze that. So where will in China? Let me go first to Pranay and then to Mark, and ask a little bit broader question about potential growth next year, and also, of course, as it relates to dry bulk commodities like coal, iron ore, grains, and so on. So as you look at China for 2024. What are you watching to see if there is some growth there? And what do you think the risks might be? Pranay?
Yeah, thanks, Sean, for having me here. Like if I talk about China, right, this year they have done a record amount of coal imports. You talk about the mid CV, high CV, low CV coal, right? All have been very, very strong, right? And they have been a very strong domestic production, right? Because the Chinese government wanted the energy security to be there. But as we move to the next year, 2024, right, can we expect the same amount of coal imports? So my answer would be, we have to see which particular CV we are talking about. If we talk about the high CV coal, which is like 6,000 above, right? So that should remain flowing into China. Right? If we talk about the mid CV, that should also flow. The impact should be coming into the low CV grade, which is primarily coming from Indonesia. So what's the reason behind it? So reason is like China itself is producing huge amount of domestic coal, and it directly impacts, right, the domestic miners. And if you remember, like 2015, 16, right, whenever like the imports become too much huge, then Chinese domestic miners tend to complain. This year they have not been complaining. Why? Because the prices of coal are very, very good, right? And they are not impacted. They're able to sell their production as well as, so both imports as well as the domestic production is able to survive. But next year, like stocks are growing up of coal, right, in the power plants, and which once the government becomes strict, right, then it will definitely impact the low grade coal. So this is about, so we expect around 40 million tons lower coal imports next year into China from the seaborne market. From the overland, we expect to remain strong from Mongolia. They have been doing good amount of coal, right? 5-6 million ton per month, right? It should continue. That is mostly the high grade metallurgical coal for the steel mills. If we talk about iron ore, like as Liz mentioned, right, China has been facing lower iron ore production, even in terms of refined, right? if you see the percentage has been going lower, right? Currently, we expect around 23 to 25% what is produced is able to being refined because the grade is lower. Same like iron ore, same like coal. And you see, Chinese steel mills are going towards decarbonization. It is not what what they're producing. Still, they have to consume domestically, but they're also exporting. If you see the EV sales, right, they're very, very strong, right? We had a trip to Australia. We see so many Chinese cars, EV cars being sold over there, right? And this is not just like if you see they have been exported huge amount of steel products to Turkey, to India, right, to other countries. And which means they also have to keep into consideration how much carbon they are emitting, right? And if the Chinese iron ore is of low Fe grade, right? And they have to get it from outside. They need to get it from Brazil. They need to get it from, from Chile, Peru, from West Africa, in Canada, right? Which will mean that the imports will remain strong. So we are positive on the iron ore imports. I think the other third commodity, which is the main driver for the Cape size, if we talk in specific, is the bauxite. And we have seen huge volatility. What we heard from other speakers also, more the voyage duration, more is the volatility in the freight rates, right? If we talk about bauxite, earlier the bauxite which is used to produce alumina and hence aluminium, right, was getting they were procuring Chinese alumina smelters were getting from Indonesia, but now they have to go as far as Guinea, and they are ramping up, right? So more the duration and more the volatility. So broadly for bauxite also, we don't expect the Guinea would be ramping up too much, but overall, right, it should be net positive, right? A couple of million tons more what they have imported this year because the demand for EVs is strong, right? Okay, the property sector is underperforming, but we are expecting that the stimulus what is given would help it, and what the shantytown policy what was creating a bubble that has gone. Government has been tackling it, and now what we see is the Chinese property market coming reverting back to the sales level to a stable period, right? So this is what we expecting. So broadly, right, overall in terms of it is coal, iron ore, or obviously coal minus negative -40, but for iron ore we expect, because of decarbonization, because of the steel production to remain a level of around 1 billion ton next year also, we expect the demand for iron ore to strong, same with bauxite. And if we talk about the third commodity like agri bulk, right, this year we saw strong flows of corn as well as the soybean from Brazil as well as from the US. But also what we expect next year is the flows to remain strong, because like energy security, like food is also very important for the Chinese government, which should remain strong. And we are expecting El Nino, which will impact the Australian crops, the wheat and the barley. If Australia wheat gets impacted, right, it has to be procured from other location, right, which would be much far away what they were able to procure from Australia. Yeah.
All right. Mark, kind of the same question here. China and dry bulk, what do you expect for 2024 versus this year?
China and dry bulk. Well, first of all, thank you for having me here. Well, there's a number of factors at play here, many of which have already been mentioned by our friends just before. I think as far as China is concerned, there's one key element that has been as discussed yet, is infrastructure investments, special purpose bonds in particular. They were quite strong this year, and I think to a large extent they've played into the support we've seen for steel demand in this quarter. Although I agree to a large extent with Pranay in terms of demand coming from vehicles, vehicle building and exports have been extremely strong in China this year. But special purpose bonds do contribute to a significant amount of demand towards infrastructures, even when the infrastructures are not really needed. And whether the Chinese government, via local governments, reissues as much special purpose bonds this coming year as it did in 2023 remains to be seen. We won't know about the quota until probably late February. So that's question mark here. A number of other aspects. Indeed, it seems demand for agricultural goods in China have been pretty strong again at the end of this year, notably wheat from the US. It's always quite difficult to know the full picture of production and stocks inventories for grains in China. So there's a question mark there. But it seems pretty healthy indeed. The harvest, at least on soybeans and corn, have been very strong, appear to be very strong this year. Always with the caveats, of course, of the impact, the potential impact of El Nino in the world, right? And if we extend outside of China, then there's a number of other items. El Nino, again, here is a significant question mark in terms of how it develops and what impacts it will have. Not just in terms of demand for energy, which has become quite significant in the past few years with La Nina, but also in terms of the crops, availability of the crops, and also rainfall in some significant locations, the monsoon in India, and of course, Panama Canal. This has been an issue recently. It does not necessarily seem to be a direct relationship between El Nino and droughts in Panama Canal, but the last very significant occurrence of El Nino in 2014 to 16 did translate into severe droughts in the region. So question mark as to how this develops. I mentioned the monsoon, the impact of the monsoon for India. There again, Indian coal imports, we would expect that to be growing quite significantly in the first half of this coming year, purely because usually El Nino relates to droughts in a drier monsoon in India, therefore less hydropower generation and more requirements for coal at a time when Indian coal procurement is difficult. They have a lot of issues with production and logistics in particular, and demand has been very strong. Inventories are very low. So there we should have a pretty strong sense of bullishness, at least, or at least support for the market in the first half of the year. And in that sense, actually, the market is not going to be as strong as it is today coming into Q1, but it won't be as bad as it was a year ago. And I think that's quite important to start the year at a healthier level. But these are, for us, the key topics to look at. And of course, there's always a possibility of some unexpected events coming up, such as conflicts, war, and all of that. But you can't expect the unexpected sort of thing.
That's true. That's absolutely true. Let me go quickly to Eva and Liz and ask kind of the same question. Coal and iron ore for next year. What are your expectations in terms of growth or no growth there? So, Eva, what do you think coal and iron ore for next year?
Okay. Coal, coal has had a magnificent year, and it's kind of ironic since, COP28 still takes place. We haven't mentioned India here. India is actually encouraging investment from the private sector to new coal-fired projects. This shows a tendency. The country's energy needs have increased about 20% in the past 3 months. And there is actually encouragement after a long time for new investments in coal projects. And I think it's because we tend to focus too much on China. There is a lot of support from India on the coal trade. As Luisa also mentioned during the presentation, I think demand for coal will be maintained at very strong levels this year. The world is still dealing with aggressive inflation, albeit the inflation rate has been moderating. We still live in a very expensive world. So, cheaper energy is much more preferable at this stage by businesses, consumers, everyone. I think the coal will have another good year in 2024. And iron ore, steel production on a worldwide basis is about to increase roughly at almost 2% this year and almost 2% next year. Most of it will come from China, as it usually does. I still think there are things to look out when it comes to, as I mentioned before, the way China is experiencing its recovery. There are sectors like the manufacturing sector has started to perform in a more positive way. We've seen that, you know, the slowdown in imports has improved last month. There are positive signs, but still, I don't think that we should set up ourselves, you know, with too high expectations, because usually, you know, these expectations are never met anyhow when they're too high. One thing very briefly to mention is the fact that although supply is favorable, and, you know, this tends to be said a lot about dry bulk, don't forget that older vessels, albeit there are too many of them across all sectors, especially, you know, Panamax and below, these vessels are mostly repaired. They don't have loans, they don't have obligations by their owners. So even at OPEX levels, these vessels will not, you know, leave the market. So this is something to look out for.
Yeah, we'll talk about that a little bit later on the supply side, but let me quickly go to Liz and ask her about iron ore outlook for next year. What do you think, Liz?
Sure. I have slightly different opinion here, because based on our analysis, 2024, the three key regions, which accounts for roughly around 95% of the global iron ore imports demand, China's demand will be reducing, and then Europe and JKT will increase. The thing is that the Europe and JKT will not be able to offset the decrease in China. But that doesn't really mean that I'm not holding a positive view for Capes or for freight rate, because, you know, a key thing to watch is the inventory level in China. As we discussed, I mean, inventory levels has been really low, roughly around 60 million tons missing from the entire value chain. This is a huge upside potential for iron ore imports in 24. So freight, you know, is either about massive restocking, like what we have seen in Q2 2022, or it's about the efficiency of vessels in certain region, like Q3 2021. So suppose there are further stimulus measures in China or better economic, you know, environment in 24, or just simply the turnover of the steel margins, right? The steel mills are making money so that they will start the restocking activity, and which will boost the ton-mile demand for Capes for sure. And apart from demand, actually, another thing I'd like to mention here is about the supply to the market. You know, next year in Australia, there will be Onslow projects. There will be Iron Bridge from FMG. So from Australia perspective, there will be more available supply to the market. And as we discussed before, I think a lot of us mentioned about the weather condition, right? Less chance of cyclone in Q1, and then the El Nino will bring more opportunities for northern Brazil as well. So iron ore supply looks quite good at this very moment. Last but not least, India is a key thing to watch, not only for coal, but for iron ore. Because typically we think that India is one of the suppliers. It is, but the imports, iron ore imports demand is rising. Though the import volume is quite low, but it has been increasing since the second half of 2023, and we believe it will continue at least to the first half of 2024. So, you know, that's why we believe that the seaborne iron ore trade flow will provide more opportunities for Capes in 24. Yeah.
All right, that's great. Thank you very much. So let me go to a different subject. The other side of the equation is shipping, which is the supply of ships. And as we heard from Luisa, we're looking for something like 3% growth next year. But I think the biggest dynamic here is what we call the effective supply. And that means adjusting how many ships you have, the number of ships you have in the water, for delays, inefficiencies in loading and offloading, bad weather, congestion, and so on. And I'll turn first to Mark. And you know, Mark, canals are back in fashion. We have it in the news almost every day. The Panama Canal, which is one of the most important waterways in the world, and it has been restricting the movement of vessels due to the low water levels. And then you go on the other side of the Suez Canal, and in the Red Sea. Obviously, last week we have this incident with as it relates to the conflict in the Middle East. So the most important waterways are again in the news, and you have to go back in the 70s to have similar situations. So first of all, what are your thoughts? Is it significant as we move into 2024? And second, obviously, the war is something that who knows what happens there. But on the water levels in the Panama Canal, have you looked into that? What do you think about that?
Well, first, we've looked quite extensively at it, actually. Yes. The first thing is the proportion of volumes that go through the Panama Canal as far as dry bulk is concerned is not huge. We're talking about 2-3% of all cargo going through it, against 5% going through Suez, for instance. But the key matter is in terms of how that affects the repositioning of ballasters, of empty vessels, for the next cargoes, notably in the US Gulf. And it is clearly having a significant impact on Panamaxes and Supramaxes repositioning. Yes, it doesn't look like the water levels in the Panama Canal, in Gatun Lakes in particular, are going to go back up anytime soon. In fact, the Panama Canal Authority is restricting further all the way down to February, as mentioned by the presentation earlier. And after that, it's a little bit of a wait and see. We don't know exactly how it's going to develop. You say the war was difficult. The war in the Middle East was difficult to predict in terms of outcome. I would say the weather is not exactly very easy to predict either. In that sense, especially in the cycle of El Nino, which hasn't occurred in a few years. So massive question mark here. But in general terms, we've seen already the number of bulker ships going through Panama Canal falling quite significantly, really significantly, to the point where further restrictions will not have as much an impact as it already has, if that makes any sense. I mean, you hardly have any bulkers going through it now. I mean, we heard of some auctions recently for to go through the Panama Canal that had just under $1 million that were not accepted, and another owner who managed to go through for $1 million. And we've heard about fees going as high as $4 million for other types of ships, right? So from a dry bulk perspective, it's not economical, so they tend to choose other routes, either via a Good Hope, Suez Canal, even through Cape Horn. We have seen a number of ships from the South American West Coast, notably for salt, going around Cape Horn, which is not that common. And now we're having question marks about the Suez Canal as well, indeed. As you said, it's difficult to predict how it's going to go, but at the moment, the hostilities are in the form of piracy, if I may say, right, from Yemeni Houthis. And it looks like essentially some military presence, most likely American presence, should sort out a significant part of it. But it could get worse, and it could actually block another canal, and then you're talking about a significant more amount of demand for vessels across the board. So that, however terrible it is, it could actually translate into something positive, at least for dry bulk earnings.
I see. Well, we're running a little bit out of time, but obviously we cannot close this panel without the more traditional question and more specifics on your outlook. So, the question is like, where do you think freight rates are going to go next year? And to make it easier, let's only focus on Capesize here, which is the largest ships that most people focus on anyway. So right now, the Capesize futures are indicating roughly 16,000 for next year. Do you think we're going to do better or worse on that? And when it's all said and done, where do you think this is going to settle? And just to set the stage, in our last year's events, futures were at 11,500. And it seems that we're going to close closer to them, 15 or 16,000 this year, somewhere in the middle there. And interestingly, our panel that last year predicted exactly that level. So let me go around and ask your opinion about that. And first, I'm going to go to Pranay. And Pranay, what do you think Capesize is do next year on average?
Well, you see, we are bullish on the Capesize freight rates. As I mentioned, right, we are bullish on the iron ore, we are bullish on the bauxite, and then the Panama Canal issue is expected to last until the end of next year, right? Which will obviously mean that now more and more ships would be passing from the Suez, which is ton-mile positive, right? And then the vessel fleet is not growing, right? If the Cape size fleet is not growing, just 1.5%, but the dry bulk commodity demand is growing to 3.5–4%, right? We can obviously divide into coal, iron ore, as well as bauxite. So it is definitely positive. So we are expecting the freight rates to hover in the range of from in the keyword 9,000 to 25, but we are expecting around around $16–17,000 on an average in 2024. Yes.
All right, Mark, what do you think the average for next year is on the Cape sizes?
Well, first of all, I do, as I mentioned earlier, I do think the market is not going to crash as much in the Q1 as it did last year. So we'll start on a better position. And I do think, I don't think Q4 will be anywhere as strong as it is being now, but I do think Q3 will be much healthier. So overall, I would do expect a narrower market for Capes, but healthier overall. So I think we're looking at around $18,000 for 2024, around that level.
All right. Liz, what's your number?
Thanks, John. I think 17,000 is quite a reasonable range, though I myself am slightly bullish about the market, but I think overall 17,000 is quite reasonable. Because from demand perspective, like we discussed that the global seaborne iron ore will be stronger than 23 because of the restocking upside risk in China, and also the increasing volumes from Australia will also boost the seaborne iron ore trade. And then on the supply perspective, the market will be supported by limited fleet growth from 24 onwards as well. The containers are taking up the shipyard capacity, together with limited order book in the dry sector. The slow growth of the new deliveries of dry bulk vessels will be the key constraints of the fleet growth in the coming few years. And of course, let's not forget the impact from CII that will boost the scrap activities in the coming few years as well. So fundamental wise, I think it looks okay in 24, but just a key risk is that with the geopolitical tension going on, it is very hard to comment whether there will be further trade pattern shift in 24. Yeah.
And Eva, what do you think of Cape sizes next year?
Well, I'm less bullish, as I already said. But 16 to 17 looks pretty normal to me and pretty realistic. I think it is achievable, and as I said, there are improvements in iron ore demand, and so far the fleet growth has been okay, especially for the bigger vessels. One thing to look out for, as Liz just mentioned, there's no capacity to build capes. If you order a cape today, you will probably get a slot in late 2026. And the fact is that although capes are a fairly young fleet compared to the rest of the dry bulk sizes, it's still going to be an aging fleet. So by the time you hit 2026, almost 10% of the fleet will have surpassed this 20-year mark. And I think this is a positive because people not being sure on what's going to happen with capes are refraining from making orders. And let's see, but maybe things will be more, let's say, more positive towards the second half of the year. I think expectations for the first half are set too high because of the past couple of weeks, and this always tends to disappoint everyone. So let's be more positive on the second half of next year.
Excellent. Great. So that was quite interesting, and it's great to see such objective and honest opinions, especially following such a volatile year for dry bulk. As one can see, and as the saying goes, it's not easy to make predictions, especially about the future. So kudos to our analysts for being brave enough here. So I would like to thank all our panelists for being here, sharing their views, and especially Liz and Pranay for staying up late for that today. It was indeed a very interesting discussion and hopefully an informative one. And with that, I'll be back in 15 seconds with our next segment on oil tankers. Welcome back. So our next hour will focus on oil tankers. Over the past year, tankers have been a bit less volatile than previous year, but still the market has offered plenty of opportunities, reflecting the ever-changing landscape as it comes to oil trading. Geopolitics have always driven shipping markets from the very old days, as trade gets greatly affected by disruptions and price dislocations that such events bring. So we cannot forget the 1967 closure of the Suez Canal due to a major regional conflict and the fortunes that were made by ship owners following that. Once again, we're in an environment that geopolitics matter a lot, and you all see the daily headlines about how it affects shipping. In addition, weather, that has always been a factor when it comes to shipping, is now affecting freight rates more than ever before. The Panama Canal, which we talked before, is creating delays due to the drought conditions, and bad weather in Europe is part of the reason for the recent spike in dry bulk rates. Now, fundamentally, the tanker market looks promising. However, with so much uncertainty, what impact those events might play on the near-term outlook? More importantly, what do your experts think of 2024 that might affect and bring more strength to the market? So now, with no further delay, I would like to introduce our next segment that focuses on the current state of the tanker market, as well as the outlook for next year. We're very excited to have with us our next presenter that has been a key voice in the shipping markets with his timely and very thoughtful presentations. As a global head of shipping research for Braemar, Henry Kura has been a leading voice in the tanker markets with his timely research and forecasts. With more than 20 years of experience in the shipping markets and research, Henry has seen several cycles in the tanker market and also been through the intense 2000s when the industry was at its highs. So joining us now live from London, Henry will provide with his view and outlook for the tanker market. Good afternoon, Henry from New York. Please go ahead with your presentation. The floor is yours.
Thanks, John. Thanks. So we've got 20 minutes, I think, to run through what's going on in the tanker market. There's a lot going on in the tanker market. John says it's perhaps a little bit less volatile this year than previous year. Not from where I'm sitting. It's just as volatile. I mean, the VLCC market has been incredibly up, incredibly down. So no, we're certainly still in a situation of intense volatility and market strength. So I'm going to try and run through, firstly, putting the market in a little bit of context, where we are today, how we got here. Let me just change this slide. There we go. So here's back to the commodity supercycle. We're taking the data right back to 2003. John's asked me to try and explain some of the terms that I use. I think some of you listening today are going to be fairly fresh to the industry. We generally measure the market in terms of daily earnings, dollar-based daily earnings. And this is the earnings that an owner will make through charter hire, either spot market or time charter hire. And from those daily earnings, they're obviously spending OPEX, they're trying to cover their CAPEX, they're trying to cover, or at least allow for the depreciation of the asset. But it's a very good way of sort of measuring the sort of peaks and troughs over the years. And this is, as I say, going back to 2003, we're looking at VLCCs in green, the largest ships, right down to the MRs in yellow, with the LR2 product carriers in the middle. And you can see there, shipping, certainly tanker shipping and frankly bulk shipping as well, it tends to exist in a let's call it a permanent state of oversupply, punctuated by rare events where, for whatever reason, you cannot build enough ships to bring the market back in line. And I think the first example of that we had was a commodity supercycle, 2004, 2008. We had some intensely strong rates. The first whiff of a rally, because there are so few barriers to entry in the tanker market, generally comes with a wave of new building ordering. And that's certainly what we saw during a commodity supercycle. So, yards were really struggling to build ships in time, but a huge backlog of orders built up by 2008 when the financial crisis hit that basically led to a very extended period of oversupply, pretty much running from 2009 until 2021. I would say. Now, in that period, demand never really recovered properly to the point that demand was running ahead of supply. But what we did have were two periods where oil supply transformed the market. So firstly, in 14, 15, We saw OPEC overproducing, and we saw secondary demand for oil tankers in floating storage, which lasted for a couple of years, and we saw some very strong freight rates during that period. As that unwound by sort of 2016, we then re-entered a period of oversupply. And 2019, on the eve of COVID, we were obviously in a similar situation of quite intense oversupply. Now, COVID was, to all intents and purposes, a disaster for tankers because, of course, it affected oil demand more than pretty much any other commodity sector. Containers and dry bulk obviously did quite well during COVID. Tankers not so much. But very interestingly, in that first phase of COVID, so the first half of 2020, we saw a very dramatic spike in tanker rates, really across the board. And that was again because of this oil production issue. So here it was Saudi Arabia who was trying to fend off the market share grab of Russia and to a lesser extent US, flooding the market with oil. Oil prices went negative at one point. It all filled tankers. So floating storage demand was very, very strong. But again, as that unwound in 2021, we had a very, very weak period coinciding with obviously very weak demand naturally because of oil demand because of the COVID lockdowns. Now, COVID obviously started to unwind in the West in 2022, took a little bit longer in China. So that unwinding of COVID at sort of end of lockdowns, movement started increasing, oil demand started increasing, and that coincided with the Russian invasion of Ukraine. And between those two elements, we started a very strong rally. And you can see from that chart, it was across the board. So this isn't just a V rally now we're seeing. This is it's all the mid-tier and frankly, even the handy sizes of the smaller tankers have benefited hugely. Firstly, from the recovery of demand, which is really only back to where it was in 2019. It hasn't been a great growth in demand. But more importantly, the Russia-Ukraine conflict has obviously, the response to that has been to impose sanctions on vessels, but most importantly, to ban Russian oil imports into Europe, into the European Union, and also US and UK and other G7 countries. And what that's done is overnight, we've basically seen all the oil, whether it was refined products or crude oil that was going from Western Russia straight into Europe, very short haul, is now forced to go in crude. It's forced to go all the way around to India and to a lesser extent China. So massive increase in ton-mile demand and length of voyages. And for the refined products, by and large, that's ending up, yes, a certain amount is ending up in Turkey, but by and large, it's ending up in West Africa, in Middle East, it's ending up in Brazil to a large extent. And of course, that's a dramatic increase in ton miles. Again, a big increase effectively in the, or decrease in the efficiency of the tanker fleet. And that really is why we are where we are at the moment. Demand growth is not great. It's been a good rebound. We've seen a solid rebound in China. But going forward, as I touch on this forecast that I've showed here, that's not a demand-based forecast. The projections for next year and the year beyond that are not particularly exciting. The big recovery is behind us now. We've got very high interest rates. We've got some very surprising economic growth, for instance, in the US, kind of sort of defying gravity to a certain extent. We do see that demand growth slowing down. China has been, a big positive surprise in recent months. For a while, we were expecting, we're looking at the property crisis, as you've seen on the dry bulk presentations, and a lot of very negative views coming out on the future of Chinese oil demand. But we're pretty sanguine about that now. So, it's there. It's small demand growth. Perhaps more exciting is going to be Indian demand growth, but this is not a demand story. The reason we have a positive outlook is supply. It's all supply. And there you've got to look at why is it that owners, despite the strength in the market we've had for the last 2 years, are not ordering tonnage. And that really is the foundation of what we see as a very strong 4 or 5 years going forward, and certainly a strong 2024. Just to give a little example of why we're saying that, it's really all about barriers to entry. So I said at the beginning, very few barriers to entry exist typically. If you've got the cash, you've got the financial investment behind you, you can go in and order a ship from the yard. Unless, of course, the yard can't build a ship or it doesn't want to build a ship. And that's what's been particularly interesting during this COVID crisis, this pandemic, is we saw certain markets, principally containers, and liquefied natural gas carriers, to a lesser extent LPG carriers. Very strong demand for new orders in the yards to build containers, LPG, LNG, that are very sort of high margin assets. Yards are very keen to build those ships rather than bulkers and tankers, because the profit margins are that much stronger. And so what you saw during COVID, suddenly yards were filling their bellies, and they didn't need to offer low prices to tankers, even though the freight market was very weak. High prices were very high, really, through 2020, 2021 even, because these yards were building these high margin asset classes. And so, yes, the tanker market has recovered, but we're still very much at the peak of the new building price, and that's been a big deterrent for owners to get into the yards and order new ships. On top of the fact that they've got a lot of uncertainty about the future of oil demand. We'll go into that a little bit more detail in another slide. On top of that, you've got uncertainty about propulsion systems that I don't think you've been discussing on the dry side, but that's a key issue on the tanker side, whether you want to dual fuel ammonia, whether you want LNG. On top of that, you've now got high interest rates, so that's increased the cost of going into that market. So any one of these reasons are keeping owners away from the yards, and this is a fairly unique situation that we've got, and one of the foundations of the optimism that you see pretty much throughout sort of tanker owners these days is saying, for some reason, and I've explained a few of them, owners have managed to show some restraint on the order books. That's not to say they haven't ordered ships. So this is showing you what has been ordered by month of order over the past couple of years. Very, very slow to start in 2022. But by the summer of 22, we did see some orders coming in, particularly for the product carriers. So moving refined products around the world, the workhorse being the MRs. Increasingly, the LR2s do a lot of the long haul refined product moves globally. And we saw some Suezmax orders as well. But beyond that, very little. Certainly VLCCs, very much restraint shown on VLCC orders. Those orders that were placed were really for 25 and 26 delivery. So again, nothing for 24 delivery, because those yards had their bellies full with other ship types. So 24 is really protected. It's a very quiet year for new building deliveries, which gives a sort of positive slant certainly to that year. And what we've ended up with, even despite these orders, is a very low order book to existing fleet ratio by historical standards. So this is quite a nice way of explaining. This chart's showing you what percentage of the fleet the order book represented at any point in time. So during the commodity super cycle, obviously huge amount of ordering going on, because you just couldn't fail to make money between those years, and up to 60% of the existing fleet was on order, which of course was a disaster for the market for the next basically 12 years, apart from that 14-15 rally. A lot of those ships didn't even see the light of day. A lot of those orders were cancelled. But again, in that 14-15 oil supply driven rally, we did see a jump in orders. It went up to about 20% for some of those sectors, even higher for Suezmaxes, 20% of the fleet on order. But this rally, nothing even close to it. So the most heavily ordered sector, Aframax LR2, really just nudging above 10%. Most other sectors below 5%. VLCCs about 2% of the fleet on order. So that's what I mean. There's really been a restraint shown by owners going into the yards to order new tonnage. And in that sense, it's a little bit like the rest of the energy complex. No one is investing in new greenfield refineries. No one is investing in new oil fields. No one is investing in new tankers. So what you do is you sweat the asset. So for 4 or 5 years, without the new orders, you're just trying to maximize the revenue you can generate from these assets. And that's really the building block, the first building block of the bullish view that we have of the tanker market going forwards. Now, I think you've discussed geopolitics briefly in other sections. We are on tankers and oil and gas tankers, let's say. We are at the front line of the weaponization of trade. For the last 10 years, we have been used as a proxy for preventing war effectively. And of course, this has been exaggerated with the Russia-Ukraine conflict. So we've seen the European ban on Russian oil, refined products and crude oil. We've seen efforts by the US and Europe to try and prevent sort of Western ships getting involved in that trade. That's been incredibly positive for the tanker market because of the long haul voyages that's generated. We've also seen Israel-Gaza, obviously, and that was threatening to, at some points, threatening to sort of, roll out into a more regional conflict. We've seen, the attacks on vessels in the Red Sea, which is, it has the potential to escalate. At the moment, we are saying in our forecast, our base case is we're not expecting to see an escalation of that Israel-Gaza conflict that affects, shipping to the extent of a blockade like we saw during the, after the Yom Kippur War. So relatively benign view on the impact of that element. We are expecting to see EU G7 sanctions remain in place on Russia. So that very positive impetus to the market we expect to remain for the foreseeable future. We're not expecting to see any further wars. So obviously there's talk of China's intervention in Taiwan. We're not expecting that to escalate into a war situation. But I present these are just the known unknowns in the world of geopolitics. We are certainly at a position where we're at a very geopolitically sensitive environment. And as I said, oil is very much at the front line of that situation. And generally speaking, it will have a positive impact. A total embargo on oil trade, fine. Okay, over time, that'll be a disaster for oil. But in the short term, the uncertainty that creates, the reshuffling of tonnage, that's a very strong positive. And of course, that Russia-Ukraine situation has been one of the main reasons the market's been so strong in the last couple of years. Just to give a little bit of color to that, it doesn't affect all ship types to the same extent. So here you're looking at ton-mile demand overall as the top of the dark green bar. And then we're showing for each ship size what percentage or what element is the Russian generated or Russian originated cargo. And you can see there really all the growth that we've seen for Suezmaxes and Aframaxes, and to a lesser extent MRs, has come from Russia. And that's just exports from Russia. It's also generated secondary trades from, let's say, the Middle East, who has refineries that would satisfy domestic demand. Now they're bringing in Russian refined products and exporting what was going to be satisfying domestic demand. So even those trades have increased. So a very big jump in trade thanks to this Russia story. And if you can present a view where this continues for the foreseeable, then obviously that support is maintained. It is obviously a very big downside risk to the market. If you can present an argument that says, for whatever reason, Putin gets the upper hand and sanctions are reversed, then clearly we're facing a very different situation quite quickly. We think that's unlikely. We think for a while Putin remains in power, those sanctions will remain in place, even if there's a negotiated settlement before that. Obviously, we've got to say something in our forecast on oil demand. I think the thing to note here is the divergence of views in both the short term and the long term is quite extraordinary at the moment. I've never seen anything like it. So for 2021, for instance, the IEA, which is the sort of the watchdog for the OECD countries, they're reckoning that it's going to be about 900,000 barrels a day demand growth after 2.2 million barrels a day this year. OPEC say it's 2.2 million barrels a day they're expecting in 2024. So clearly a big spread there in what the expectation for demand. We're somewhere in the middle, probably a little bit closer to the IEA at 1.1 million barrels a day. We take a fairly benign view of China. We think, let's say 4 months ago, it was a slightly different picture, but now pretty sure China's going to hit its 5% targets. Oil demand has been pretty healthy up until recently. The margins have come down a little bit in recent weeks, so that's sort of dented demand slightly. But generally speaking, we think the demand is solid. For next year after that, it gets a little bit weaker. The year after that, it gets a little bit weaker still. So we're not big fans of China, which is not a super strong story for the V market, which is very heavily dependent on China. We don't think much is going to happen with OECD demand. We think that's going to carry on declining. And of course, this is all part of the energy transition. China, for instance, has surprised everybody by its rate of adoption of electronic vehicles. In the past year, that will dent demand, not yet, but it'll certainly shave some of the percentage points off our forecasts going forwards. As you saw in that first slide, oil supply is very important on a temporary basis. So demand is what really drives this, or a relationship between supply and demand. But then for short periods, you can get too much oil coming into the market or too little. Right now, we're expecting a short period, certainly in the first quarter of next year, probably a little bit too little. So that's damaging in effect. It's taken a little bit of the optimism out of the V market, which relies on OPEC output, a lot of which goes to China. But it does mean that when demand is, as I say, it's relatively solid next year. So at some point that output increase is going to have to kick in, and we think the second half of next year should be reasonably strong, especially bearing in mind the VLCC market adds 1 ship next year from the new building order book. That's unheard of. Usually it's 40 to 60 per year. So that's our view on OPEC. US growth has been very strong in the last couple of years. That flattens off a little bit, but generally speaking, Atlantic Basin supply massively outpaces OPEC supply, and that, given that demand is coming from China and India, is quite a strong ton-mile story that will support the larger ships. I mentioned the longer-term demand scenarios. I'm just showing this really for a bit of fun, just to show you divergence of opinions from the brown line, which is the IEA's view of what oil demand would have to do if we're to hit net zero by 2050, to the blue line, dark blue line, which is what OPEC's October projection was for oil demand actually increasing until at least 2045. And that, in fact, if you can see the light blue line, that was OPEC's view in actually it says October. That was actually June 2022. Sorry, no, it was October 2022. It's improved, or it's increased its optimism since 2022. We're again somewhere between the two, but generally speaking, we do see demand growth over the next few years. We cannot see an avoidance really of the energy transition within 5 or 6 years. Now, bear in mind, I've shown on that chart the economic lifespan of a new building ordered today, which could be anything between 20 to 25 years. Owners are now generally tending to amortize their ships over 25 years. This is one of the issues that owners have when ordering new ships. No idea what that demand scenario will look like. And you're at the peak of the asset curve, very little to offer investors on the upside. That's what's keeping, to a large extent, owners away from the yards. So back to our outlook, just to quickly rattle through some of our numbers. Again, take it with a pinch of salt. There's a lot of unknowns in this market, particularly on the geopolitical side. But what we're saying is we've had very strong demand on the crude, particularly crude side. We call it dirty because it's moved on uncoated ships, and it includes fuel oil. So the dirty side of the market, which has been by far and away the most volatile for the past few years, has grown very strongly. In the last 2 years, grew probably 7.6% this year. Refined product trade grew 4.5% this year. So again, very, very strong recovery, adding to what we saw in 2022. That changes quite dramatically next year. So as I said earlier on, the demand story is not exciting. We're down to just over 1.2% for clean trades, down to 0.8%, we're saying, for dirty trades. We do think that demand growth is going to be stronger for refined products than it is for crude, partly because we are seeing refinery closures. So they shift what was being imported as crude oil to feed a refinery to importing refined products, particularly OECD. But again, not a particularly exciting demand picture, but it is growth. And as I said at the beginning, when you lay that up against a very weak fleet growth, or frankly flat fleet growth is what we're saying, that gives a fundamentally strong forward view to the market. I just want to say a couple of words about our forward view of supply. I've mentioned already our view of new building orders. So we've got the grey bars there. That's the scheduled order book that we know about. The yellow bars, that's what we're expecting to see. A very conservative view on new orders, but for all the reasons I've given you. Below the line, you'll see this is what we're saying left the market in orange and will leave the market in green. Now, this is very important because the other side of this market is we have, over the past few years of very strong markets, not scrapped pretty much a single tanker. Obviously, you can see in the past, periods of strong freight markets, you don't scrap. You only scrap in weak freight markets. We're not expecting that to change in 24. We think the market will remain strong. Ships will not scrap. But the result of that is the fleet is getting a lot older. And there's a lot of ships that are already over 20 that are being actively employed, particularly in these shadow trades that have emerged because of the sanctions on Russia, on Iran, on Venezuela. They've allowed 20-year-old vessels to move into these sub-trades and give them plenty of gainful employment, that's very unusual in our market. You know, the main charter market, you don't fix ships over 20 years old. Main charterers, including Chinese, will not touch ships over, or very rarely touch ships over 20 years old. The scrap age or the removal age is generally 20 to 21 years old over the past 5 years. In some sectors, maybe it gets up to 24, but it's certainly not 25. Okay, so what we're saying is we have a fairly aggressive view on what starts to leave the fleet, has to leave the fleet from 25 onwards. And that leads us, you know, this is just to give a little bit more flavor to that. This is our year, you know, fleet by year built. This is the entire tanker fleet over 25,000 tons. That area in red is showing you about sort of 8%. This is just the trading fleet, not including the ships that are in floating storage or idle, just the trading fleet. You know, a good 8% is already over 20 and really shouldn't be trading. It's only trading because of these sanctioned trades. But importantly, going forward over the next 5 years, you've got a lot of those ships that were ordered during the commodity super cycle that are now hitting 20. And so there's going to be some big question marks about these ships. The vetting is going to be stricter. You've got environmental concerns coming on. You've got regulations, whether it's, you know, European carbon trading scheme. You've got, you know, CII regulations, all of which are discriminating more and more against higher consuming older vessels. And a lot of them are hitting that 20 mark, certainly when you compare it to what's coming into the fleet over the next few years. And that's the blue bars towards the right of that chart. So again, you know, even if the market does come down, you've got a lot of these ships that could effectively leave the fleet, but at some point they will have to leave the fleet. And I would say, although the Russia-Ukraine story presents a very big downside risk, the upside risk would be, for instance, an accident on one of these older ships, where suddenly, you know, you've got an immense amount of pressure on receivers not to receive over 20-year-old ships. You know, we've had accidents, fortunately with no spills, on oil tankers, where, you know, engines have failed because they've been poorly maintained. You know, the possibility of that sort of eventuality over the next 3 years, I would say, is relatively high. So for as long as we keep these substandard over 20-year-old ships in play. It varies a little bit from ship size to ship size, particularly serious for the MRs, so many of which were ordered during the commodity super cycle. But you can see really the share of ships that are old, you know, it kind of defines how many ships are ordered. So, you know, we don't have quite such a big problem of ships turning 20 on the VLCC side. And one of the reasons we don't have quite such a big order book on VLCCs. So back to our forecasting. If you look at the relationship between supply and demand on a fundamentals basis, it looks pretty good. So those orange bars of demand on the right-hand side, those are you know solid demand numbers, certainly historically. They go back to sort of 1%, a little bit lower by 26. Not great demand, but the supply is pretty much flat. And so that's our gray bar going forwards, you know, 24.3% versus 1% demand. So that's a good sort of solid fundamentals outlook. Okay, and that's sort of reflected in that chart on the left-hand side that shows you our flat fleet growth versus the oil on the water, which is our sort of main measure of tanker demand. Before I finish, I just want to mention a couple of, and this is really perhaps to feed into the panel that we have after this, a couple of short-term known unknowns that would affect the sort of regional markets, or perhaps some size sectors more than other size sectors. So 2024, we've got some very big refineries coming on stream. Well, one principally is Dangote in Nigeria, 650,000 barrels a day. It's a monster single train refinery that could, in theory, reduce Nigerian crude exports and dramatically cut West African refined product imports. Be interesting to see what the others on the panel think about that. We're actually got quite a positive view on the product side as a result of that change. Dos Bocas, another one in Mexico, is intended to come along this year. Smaller refinery, but could change the US Gulf trades. We've got a Trans-Mountain pipeline expansion coming out of Vancouver during this next year, which potentially shifts trade from VLCCs in the US Gulf to Aframaxes on the west coast of the US and sort of accelerating that Pacific trade. And as you saw on the dry side discussion, Panama Canal, it's not such a big deal for tankers. It generally affects, well, obviously Panamax tankers, but there aren't many of them. It affects MRs, it affects tonnage lists, it increases delays. We're about 20 days delay for an MR in the US Gulf now. So it's shortening those tonnage lists. It's giving impetus to those rates. But I just wanted to, throw these in there just to give a bit of a flavor for the sort of infrastructure changes that might affect that market going forwards. But I think you're getting loud and clear that we're pretty bullish. We do see downside risks. We see upside risks. For instance, we are saying that without any fleet growth at all, potentially a shrinkage of the fleet could be an interesting year. So yeah, watch this space. But I think things are looking pretty positive on the tanker side. I think we're going to go through a few questions now, but that's all from me.
Oh, that was great, Henry. Thank you very much. One question I had by looking at this phase out chart on oil demand and at the same time at the order book, it seems to me that obviously energy investments have been very slow and they're moving from carbon intense forms to obviously the green technologies. But, there is kind of like a supply buffer there with other forms of energy like coal, for example, natural gas. If this transition is delayed or it takes a longer amount of time, you can see an environment where oil transportation becomes crucial. And there you don't have a buffer, right? Because you don't have the new building, the new building order book. Is that the right way to think about it? And I'm not talking about next year, probably towards the end of the decade, right?
Yeah, I mean, it's hugely important. If OPEC's got it right, maybe there's sort of more use of carbon capture and the development of alternative technologies is slower than we think, or it's more expensive than we think. Then yeah, I mean, I'm not talking about OECD, I'm not talking about Europe particularly or US, because there we are seeing the energy transition, we are seeing genuine commitments to reduce demand. There, the demand will be flat. But India, huge demand growth. Southeast Asia, huge demand growth still. At lower prices, they want to keep the lights on, and they're going to be, as they become more affluent countries, they're going to want to approach the per capita energy consumption of the Western world. So yeah, I mean that's the OPEC view. It's great to have these targets in place, but the reality on the ground is, oil demand's going to carry on going up, and we do not have a fleet there to beat it. And it's an aging fleet that's existing already. So we've got the scrap issue to worry about too.
I mean, there is a stunning difference of opinions between OPEC and IEA, and I'm sure a lot of this is political, but looking at this chart, I mean, it's day and night.
Yeah, I mean, IEA is the sort of the main thrusting force of energy transition. So one could argue that it's it has its vested interests and wants to encourage this transition by saying oil demand's going to go down. So we've got to step up to the plate with these solar and wind and so on, nuclear. Whereas OPEC is a little bit more pragmatic about it. How many times in the past 30 years have we been talking about peak oil demand or peak oil supply, and yet time and time again, when you try and remove supply or demand, it doesn't happen, and we're still here, at 100 plus barrels a day, perhaps looking to go up to 100 and 510 before it starts peaking.
Yeah, absolutely. Great. Thank you very much, Henry, for your time and insights. And we'll be right back with our second panel of the day, focusing on tankers in 15 short seconds. So our last segment of the day also focuses on tankers. And as we heard from Henry's presentation, the uncertainty around geopolitics continues to make the fundamental analysis complicated, especially for the oil-dependent tanker sector. However, there is more to consider than just that, geopolitics, and hopefully our next panel will shed some light on all those factors. Now, for that, I will go to Athens and my colleague Thanos Ophios, who will moderate our next panel on tankers. Tana, good afternoon from New York. The floor is yours, so please go ahead with the panel.
Thank you, John. Good afternoon from Athens. Once again, the global oil market has entered in a new phase of uncharted territory, characterized by significant supply and demand side risks. We are glad to have with us 4 distinguished guests who have followed tanker shipping for many years and still focus on a daily basis on every aspect of it. They will provide us with their views on the current state of the tanker market and give us their outlook for next year. Our panel today includes Pamela Munger, Senior Market Analyst at Vortexa, joining from London, Nadia Martin-Wiggen, Director at Sveland Capital, joining from Oslo, Eric Bruckhausen, Manager Marine Research and Consulting at Poten & Partners, joining from New York, and Ole Rikard Hammer, Senior Analyst, Oil and Tanker Markets at Arctic Securities, joining from Oslo. Good afternoon, everybody, and let's get started. The tanker market is recovering from a long period of staggered rates as the growth in new vessel supply shrinks, while oil demand is recovering in line with the global economy. A historically low order book, combined with favorable demand fundamentals, should continue to support increased spot rate volatility, which, combined with the ongoing geopolitical turmoil, should support freight rates in the medium term. The question is, and we'll go around to ask the same to everyone here, what is the current health of crude freight markets and what lies ahead for them going forward into 2024? First to Pamela.
Yep. Thank you very much for having me on. Yes, currently VLCCs are showing the most stability with rates remaining steady at relatively high levels in the past month or so. This has been really supported by the long-haul flows from the U.S. Gulf Coast into East Asia, especially South Korea and China. And we'll talk a little bit more about that later on the going forward picture. For Aframax and Suez markets, we've seen some strength, particularly in the Atlantic Basin, where Aframaxes were supported on the U.S. Gulf Coast to European route, while Suezmaxes were able to reach record high ton miles towards Europe. However, regional increases in tanker availability, Aframaxes in the U.S. Gulf Coast and Suezmaxes in West Africa saw the Afra-Suez Max rates take a dive and declining by around 20%. So Suezmaxes seem to have been seen the biggest decline in ton days towards Europe, while Aframaxes seem to have some support on the demand side as WTI delivered prices remain relatively low. Now, on the road ahead, certainly crude tanker demand upside may be limited towards the end of the winter. This is the very near term, and also due to a very well or possibly even arguably an oversupplied product market. However, seasonal pickups in demand are likely to keep rates from sinking too low. So overall, 2024 will highly depend on the refined products market. Crude or dirty freight follows crude. Crude follows what the refineries are doing and refined product demand. And as I captured some of Henry's very good presentation, certainly the outlook for refined product demand, especially in your bigger markets such as China, looks like it has some limiting factors, especially as it's already enjoyed its sort of post-COVID recovery as far as demand is concerned. Now, the other beneficial factor for freight, of course, has been longer trips. Will they get longer? That's the next question. How can they get longer? One thought is if OPEC continually cuts crude exports, then, for example, the Asian markets may become more dependent on U.S. Gulf Coast for crude, which, of course, will be very supportive for freight rates, especially the larger vessels.
Thanks, Pam. Eric, what are your thoughts? How do you view 2024, and what are the differences that will make it stronger or weaker than the past year?
First of all, Thanos, thank you for inviting me to participate in this panel. Appreciate it. In terms of your question, you're right. The oil and tanker markets are going through a very turbulent period. And the developments that you and Henry in this presentation mentioned earlier have made the freight market quite unpredictable. Here at Poten, we're looking at 2024 with a sense of optimism for the freight market. We think that tanker freight rates, which have been generally strong in 2023, could be even more robust in 2024. And there's a couple of reasons, I think, that have been mentioned before as well. We think that the oil supply disruptions as a result of the Russia-Ukraine war are likely to continue. The sanctions associated with this conflict have already created massive dislocations in our markets. Compared to 2023, what we think might change is we think we will see more active enforcement of the G7 sanctions on Russia, which could further boost tanker demand and rates to the extent that people will go after the dark fleet that is currently operating in the Russian trades. Less tanker supply growth, that was mentioned by Henry as well. Obviously, especially for the larger crude oil tankers, very few vessels on order. And there is, again, more upside if there's more of a clampdown on the shadow fleet of all the tankers. And there's a couple of wild cards for 2024. You have the widening of the Middle East conflict, which is very hard to predict. We have the Panama Canal restrictions. Chinese oil demand could go either way, and as was mentioned before as well, OPEC versus non-OPEC production. Lower OPEC production tends to get compensated for by higher non-OPEC, and at the moment that means longer haul trades. So those are some of the factors why we think 2024 might be another strong year, maybe even a little bit stronger than last year.
Thank you, Eric. Ole, what are your thoughts, again, on your outlook for 2024 versus last year?
Hi, Thomas. Thanks for having me on. I'll repeat basically what some of the other panelists are saying. We're quite bullish on the coming year. We think oil demand growth is looking quite strong. The 2023 has been a year of very, very strong volume growth and distance growth. So the ton miles, which really drive tanker demand, has been quite exceptional. We estimate maybe growth of around 8 to 10% over 2022. That's going to slow down next year, but we are definitely going to see growth. We disagree with the current recession talk that's roiling in the oil markets. We think demand is going to grow, particularly in China. Last year, we saw some issues with the rising interest rates, which limited inventories. That's probably not going to be the case this year. So we think the demand side is looking quite strong. Sanctions will remain in place until further notice, we guess, and that's going to provide longer distances. We think Middle East supply actually is going to increase next year. The oil market is going to need it, and that's going to be good news also for tankers, provided it's driven by strong demand. Supply side, we've heard from the other panelists. We don't need to get into that. I think the supply story for tankers is quite unique, with the extremely low order book and a quite old fleet, and the sanctions. So that means on the fleet capacity side, things definitely look tight. So our view is that 2024 probably is going to be at least as good as 2023, and probably somewhat ahead of the current FFA estimates. Thank you.
Thank you, Ole Rikard. Nadia, I turn to you. What do you foresee 2024 will bring versus 2023?
Thank you for inviting me. I think, as we've heard from the other panelists, the freight market is pretty bullish. And what we see right now is Brent is at $75 and it's struggling to hold that. And why is it struggling? It's because of demand concerns. Why is OPEC cutting? It's because of demand concerns. Our view is that supply in terms of crude will continue to come from the US, from Guyana, from Brazil, which are all bullish for the tanker market, unless we get a complete price crash. But still, the concern is demand. And if there's not demand, OPEC is really under pressure to continue cutting, which would, of course, be negative, especially, when we look at the Arabian Gulf rate going into China. On the second point, though, if we take that oil prices will actually trade lower, if we accept that, right? Let's say oil prices trade down to 70 Brent, a little bit lower, into that healthy range for the Biden administration. That's where we see that sanctions could come back much harder on Russia and on Iran and on these shadow fleets, right? Which would make it much more difficult for that part of the market to move, in which case you then have more pressure and need on the proper tanker market, right? For those actual crude flows to come out of the correct countries and use the right fleet and also have more production from OPEC. We saw that at $95 a barrel Brent, the physical market couldn't take, demand really fell away. We saw that WAF was being backed up, not flowing into China. We know that that's the ceiling. Now we're trying to figure out where is that healthy floor for demand to really come back. So we think that at, $50,000, $60,000 a day, it's a healthy tanker market, but we think that the optimism of, $80,000, $90,000, $110,000 a day is way too optimistic based on the demand story right now in crude. Thank you.
Thank you, Nadia. That was very insightful. The IMF forecasts that the global economy will grow by 2.9% in 2024. Global oil consumption is expected to hit a new record of more than 100 million barrels per day. New oil supply is coming mainly from the Americas, as we heard from Henry's presentation, while new refinery capacity is added mainly in Asia, causing longer sailing distances for crude tankers. What is your outlook regarding the demand for crude oil? Pamela, I turn to you for this one.
Hi, thanks again. Yes, I think the demand for crude, let's start with China. First off, we look at China, which has been a big black box for most of this year. The demand momentum is certainly slowing in China for seaborne energy imports, including crude. The refineries there, margins are not doing too well. They've already cut runs for this particular period now. The Shandong, the independent refineries, which take a lot of their crude from the sanctioned market, so Iran and Venezuela, to some extent Russia, are really doing very poorly. So what we're seeing is, going forward in 2024, how much upside potential is there really in China? There's one new refinery coming online in China, my understanding next year. But other than that, we're not seeing loads of new refining capacity coming online. The Dagonte refinery was mentioned, and if that does come online, we are currently, there's a lot of doubts in the market as to when. I know they've been seen as bringing in some crude vessels recently, and which gives the impression that the refinery could be starting sometime soon, but there's still a lot of question marks about problems with the refinery. But of course, that will temper those crude exports coming out of West Africa, as it was mentioned, which is obviously not too great for the freight market. Now, in terms of refined product demand, again, looking forward globally, our flows certainly have a strong indication that import demand for refined products is quite is fairly bearish overall, especially in the Atlantic Basin. We're seeing a decline, if you will, in product imports for the main refined products of diesel and gasoline, which of course will always back up into the crude market.
Thank you, Pamela. Now I would like to move to a subject that we touched a bit before, and that is in everyone's mind. Nadia, this one is for you. How is the crude oil trade being affected by the two wars, the one in Ukraine and the one in the Middle East? The demand for crude, the production, and eventually the tanker market itself.
Yeah, so as we've seen, really since the war started last year and the sanctions with price floors were put in, Russian crude continues to flow out, but it goes over longer distances. And we expect that to continue to be the case, both for crude and products, barring a situation where we get into a low price environment that the US actually decides that we can afford to lock in more Russian oil. With the latest OPEC cut agreement, or voluntary agreement, Russia has agreed to export 200,000 barrels per day, less in terms of their exports, right? We don't really think it's a production difference. It's quite interesting when we view it versus the summer, because in the summer, May, June, we saw a peak in Russian exports. We don't believe that it's not that Russia can't produce more. We think maybe they were hitting the capacities in terms of their fleet and logistics, right? So we expect that to continue / have 200,000 barrels per day less coming out of Russia, but nothing like 9 million barrels per day of production like Saudi Arabia is doing. Now, when we look in the Middle East, there has been a huge war premium that came into the market at the end of the first week of October when we had the Hamas attack on Israel, but we haven't had a true realization of an escalation. There have been Houthi attacks that have gone into the shipping space, and we are monitoring this very closely, what happens in Suez, what happens in the Red Sea. And let's say if it were 10 more attacks, things will become more serious. The main thing we're really watching is what happens with insurance, right? When insurance rates start to go higher, then everyone will be diverting the ships. Also, there's a shortage of personnel in the shipping industry, right? So the crew can actually refuse to go if they think it is too dangerous. That is not our base case scenario, but that is absolutely a much higher risk than how the situation looked in August this year. So on those two aspects, we think the war premium is still maybe to come, especially in the Middle East.
Thanks, Nadia. I turn to Ole for more or less the same question. What's your outlook, Ole, regarding the demand for crude oil? And also, please give us your comment on the effects from the geopolitical developments.
Hi, Thanos. Again, yeah, as I said, we're quite bullish on oil demand in contrast to some of the, let's say, current narratives in the market where people are fearing recession. That's been an ongoing case for oil during the past 12 months at least. We saw during the past year significant upward revisions to oil demand from the IEA to the tune of nearly 1 million barrels per day in an environment where people are talking recession. That's about 1 percentage point. That is hugely significant. We think China is going to surprise again on the upside this year. Chinese growth has been very strong on oil demand this year. It's slowing, but it's not going into recession. We think the authorities are going to stimulate the economy, and we're seeing some encouraging signs from other markets that we think the Chinese economy is heading in the right direction. Also on India, it's been a relatively quiet year, but India's growth is showing clear signs of picking up. We think it's going to be stronger next year. So with the dominance of Asia in oil transportation demand, these are quite encouraging signs. On the Atlantic Basin, we are actually quite optimistic regarding, or certainly less pessimistic regarding the US. The economy continues to surprise. You got a very tight labor market and relatively low prices. It's very, very hard to see US demand going down in that kind of environment. As for Europe, That's been the weak spot. We think next year maybe it moves to be just a soft spot. So we're thinking oil demand growth of maybe 1.5 to 1.8 million barrels per day. That's in line or somewhat above the pre-COVID trend. It's down from this year 2.4, but still a very robust growth rate. As for the geopolitical situations and the wars, certainly let's hope that they all end. But in reality, it's been by far the war between Russia and Ukraine that's had the biggest impact. And we heard all about the dislocations of trades. They become much longer, but also keep in mind that Russia added a lot of volume also to the market by triggering the release of the SPR supply. So both volume and businesses have been positive. We're assuming, that continues, so status quo on that side, but obviously we don't know anything for sure. As for the Middle East conflict, so far, very little impact on oil and tankers, but it has a huge capacity to spread, which could be quite dramatic given the Middle East role as an exporter. And that would be a double-edged sword for tankers. What we know about those conflicts is that if there is an inkling of that conflict spreading, it's going to shoot up tanker rates right away as the market really goes after all the oil that's available. What happens, and beyond that, hopefully things would settle down, but there's also a clear risk that there could be an oil price shock, which is bad news for everybody. So kind of a mixed pattern there. It's a fact of life that the wars have the potential to impact demand and trade flows. What they don't have that much impact potential to impact is on the fleet side. So the order book stays low and all the positive things on the fleet remain in place. So sad to say, I think the wars will contribute in the tanker space. Thank you.
Thank you, Ole. I'm going to build a bit on your last comment. Freight rates are driven by the demand for crude oil and the supply of available tankers to transfer it. Eric, on the supply side, tankers order book is relatively low and known. Is it the result of uncertainty regarding new regulations? Can we see a pickup? Does it really matter for next year at all?
Thank you, Thanos. Yes, I think that you're right. The reason the order book is where it is, Henry also referred to that, it's the uncertainty around regulations, what kind of engine, what kind of fuel you would want to use. On top of that, we have very high prices. New building prices have escalated quite considerably over the last 2 years. And then we have higher interest rates, less interest of the sort of traditional ship finance institutions to get involved in shipping. At the same time, some of the private equity guys have stepped back. So there is a general tendency that there is high prices and have prevented people from ordering. So where we are now, we have a low order book, in particular for the largest crude tankers. So the VLCCs, very large crude carriers, just as an illustration of that. The current VLCC fleet is about 890 ships. 174 of those, that's 20%, are 18 years or older. So you would expect those ships to be phased out over the next 3 to 5 years. However, if you look at the order book, there are only 24 ships currently in order, and those ships are delivering from 2024 through 2027, 2028. Obviously, there is some room in the order book if you were to order now to get ships delivered beyond 2026. But there is nothing you can order now, you can do now that would get you a ship in 2024 or 2025. So we foresee a pretty tight market. And that's the order book side, right? So there is, if you look at fleet supply, there is also the other side of the equation, which is scrapping, as we used to call it in the business, but now we call it recycling. there has been very little scrapped in the last couple of years. In the last year of some sort of meaningful scrapping was 2021. And that was in the middle of COVID, and the market was terrible. 2022, that stopped. 2023 was even lower. And what happened is a lot of the older ships, rather than being recycled, they were sold into what we call the dark fleet or the shadow fleet, as Nadia mentioned it. So those, we see that as a one-way street. And if there is any kind of further sanctions that are better enforced, or God forbid, a oil spill of one of those ships in sort of an environmentally sensitive area, you could see a very significant pickup of scrapping. And when there is a reduction in the fleet and there is nothing on order, that would make the situation even more tight than it already is. So that's, I think, the way we see it. There is already increased scrutiny from the IMO, also from the G7 countries regarding the use of these older ships in the Russian trades. And I think we are one major accident away from a significant increase in recycling. Thank you.
Thank you, Eric. Indeed, limited supply growth combined with record oil consumption and longer sailing distances drive the market. It seems that supply-demand balance should tighten further in 2024. Now for the end, I kept our traditional question on outlook, so here it goes. Freight futures for the VLCCs on the benchmark route from the Middle East Gulf to China are currently priced in 2024 at about $42,000 per day. Do you think spot freight rates will exceed these futures market expectations next year? Let me go around and ask you for a rough number, but also what could surprise us to either the upside or the downside. Eric, I start with you.
Yeah, we are pretty bullish. So we expect the numbers for 2024 to be above the $42,000 a day that freight futures indicate. Potent's 2024 forecast for VLCCs is around $53,000 a day. What I have to sort of explain, I'm not sure what type of VLCC is used for the freight futures. That obviously will make a difference. Our forecast is for a regular ship with an exhaust scrubber installed, so that allows those ships to use the cheaper high sulfur bunker fuel. A vessel without a scrubber would earn less because they have to use the more expensive fuel. But on the other hand, modern vessels, like what they call the eco, more fuel efficient ships, could substantially outpace those earnings. So this 53,000 that we have is sort of an in the middle. It could be a couple of thousand less for ships that have no scrubber, or it could be a couple of thousand more for eco vessels with a scrubber. In terms of what could happen, wild cards, I think we mentioned many of them already before. The escalation of geopolitical conflicts. I mentioned a major oil spill that could happen. I think that risk has increased because of the use of older ships in these dark trades. A global recession is a downside, but I think I agree with Ola that risk has sort of faded somewhat in the background. That's a very low risk at this point. China is an important driver of our market. So where China goes on the demand side is going to be important. And I think the non-OPEC versus OPEC market share fight is going to be interesting to watch as well, because ultimately it seems that if markets go down in terms of demand, OPEC in the past has sort of made room for non-OPEC, and then they were the ones cutting production and going back to fairly low levels. If history is any guide, that only goes so far. In particular, Saudi Arabia, they have a couple of times in the past have said, okay, enough is enough. We're not cutting anymore. So we will open the spigots and we'll overflow the market with oil to put some discipline in the market, if you will, for the other producers. There's no way of saying whether that is they have similar thoughts again, or what level oil prices would have to go to make that happen. But it is something that has happened a few times in the past, and that would create a bonanza for the tanker market, definitely. Thank you.
Thanks, Eric. Ole, what's your rough number, please?
Good. Yeah, so I said that we're relatively bullish. So the FFA is at 42,000, and that's a buy in Arctic's book. Our forecast is for $49,000 per day average for a comparable vessel. I think the upside risks here, I think, are on. I like the demand situation. I think the geopolitical factors are mainly risks on the upside. On the downside, a hard landing for China is bad news. An oil price shock, as we discussed, which could come as a result of the conflict or escalating in the Middle East would be bad news. But I agree with Eric that with OPEC already having cut quite a lot, if they were forced into sort of cutting more, I think Saudi Arabia may go the other way around and increase output in order to make it a hard landing in the oil market, but as quickly as possible. So I would say geopolitical risks on the upside, while still watching the macro side. Very hard to see anything on the fleet capacity side, which could bring the downside to this market. Thank you.
Thank you. Thank you, Ole. Nadia?
Yeah, so for us at $42,000, we think of that as around $50,000 to $60,000 a day in the physical market, and we think that is a healthy price, and we don't really see that much upside for that in the near term. But of course, we are in refinery maintenance season in Q1. So the biggest problem is that crude demand issue in the first quarter. The second quarter, we expect things to improve from a demand perspective. But then again, the market has been expecting this in Q3 and Q4, and both have been disappointing. So the trend has definitely been against us this second half of this year. So we think it's kind of a fair price and everyone is happy and does well. When we think about what are the upsides and downsides for next year, I mean, number one, demand really picks up, right? We see China really going for things. That can absolutely impress things. On the supply side, we expect 1 million barrels per day of production growth coming from the US, Brazil, and Guyana. All very bullish for the tanker market. We have China TMX probably coming on, Canada's TMX pipeline coming on end of Q2. So that will, of course, divert and create some pressure on that Arabian Gulf stream to China, because that's at least 200, maybe 400, 500,000 barrels per day of crude that can flow out of Pad 5 and Canada over to China. So that is the downside. But, we don't think the biggest impact will be on that part of the market. The biggest impact will happen on the smaller tankers and on the different rates in terms of that positive upside. And then finally, if OPEC gives up, we see a real situation now where storage economics and contango in the US is a big deal. What are we going to see with crude exports now happening in Q1? And this is where that would be extremely bullish for tankers initially when it's used for floating storage. But then, of course, as the market rebalances and supply has to come down, it would then be bearish. And all of that can easily happen within 2024. Thank you.
Thank you. Thank you, Nadia. And we kept Pamela for the end. Pamela, please give us your estimation for VLCCs for 2024.
Yeah, I mean, I think I hope I'm not punished for having an alternative view here. That's why I was saved to the end. But I think that compared to what the forward curves look now, certainly we're bullish those particular rates. I mean, I think a lot of it does depend, like all the panelists had said, on China. We just particularly have a view that China overall demand is still relatively weak, and we don't see a lot of upside growth in China in terms of their demand. I mean, one strong point for the freight market, of course, will be that China overall, despite a weak demand, their long-term partners could have an advantage over spot suppliers. So Saudi-led Middle East producers and Russia will likely maintain their volumes, but of course, African and American producers may see, it may have a more of an impact on those markets. I mean, it's, that's kind of what's kind of out there. I mean, the independent refiners, they really only buy discounted barrels on spot contracts. So Iranian, Venezuelan, Russian volumes could be at risk. But the state-run support to Russian barrels will balance, of course, off the demand decline from the independents, the Shandong refineries. The Russian crude will likely still be attractive to Chinese companies as state refiners will not take Iranian or Venezuelan crude. Yeah.
Okay, thank you, Pamela. That was great indeed. I would like to really thank all our panelists for being here and sharing their views. It was indeed a very interesting discussion and hopefully an informative one that provided some food for thought on the outlook for the tankers market. And with that, I will turn it now back to John in New York. John?
Thank you to our panelists for their views. And again, thank you, Thanos, for participating on that. So that was our last panel of the day. We covered issues that account for about 75% of global trade today. Two segments that an investor should always keep in mind, as the signals coming out of those sectors can affect a number of economic developments globally. Again, I would like to thank all our panelists that made this event possible. We hope you enjoyed the discussions and are a bit wiser today on those very important issues when it comes to the global economy. So that concludes our Breakwave Day. Thank you all for joining us. We wish you all the best for the new year and looking forward to continue the discussions for the years to come. Enjoy the rest of your day.